Did you know that as of 2024, the global mutual fund industry is valued at over $40 trillion, with index funds rapidly gaining popularity among investors? But what exactly sets these two investment giants apart? Hello, savvy investors and curious minds. Today, we're diving deep into a topic that's essential for anyone looking to grow their wealth wisely: the comparison between index funds and mutual funds. In the field of investing, these two kinds of funds are frequently discussed. Nonetheless, they have unique guidelines, advantages, and concerns. Making investing decisions that are in line with your financial objectives and risk tolerance requires a grasp of these distinctions. We will cover more ground in this video than just the definitions of index and mutual funds. We'll examine how they operate, their benefits and drawbacks, and how they fit into your overall investing plan. Our aim is to give you precise, valuable insights, regardless of your level of experience as an investor. You'll be prepared to decide where to invest your money once you see this video, so that's a plus. Together, let's solve the puzzles around mutual funds and index funds. Understanding index funds. Let's start with the basics. What are index funds? Imagine a shopping basket. But instead of groceries, this basket contains a little bit of every stock in a particular market index, like the S&P 500. That's essentially what an index fund is, a type of mutual fund or exchange-traded fund designed to match or track the components of a market index. The simplicity of index funds is their beauty. They are a method of investing that is passive. These funds mimic the performance of the market rather than attempting to outperform it. Consider it as following the river's course, as opposed to trying to forge ahead of it. Let's speak about benefits now. Lower fees are one of the main benefits of index funds. The expenses to you as the investor are lowered when active management is not required. It's similar to purchasing a premium item at a discounted cost. An additional benefit? Extensive exposure to the market. Purchasing an index fund is like slicing up a tiny portion of the world market. When you invest in this diversification instead of individual stocks, your risk can be lowered. However, not everything is sunshine and rainbows. The passive nature of index funds is one of their drawbacks. They only mirror the market index, so your investment will decrease if the index does. You can't maneuver to avoid downturns. It's like being stuck on a railroad track with no rapid course correction. Furthermore, although having a wide range of investments lowers risk, doing so may prevent you from earning the high returns that certain actively managed funds can produce in favorable market circumstances. Stability and the possibility of more significant gains are traded off. It's essential to know these benefits and drawbacks. Index funds are a valuable tool for long-term investing, but as with other devices, their best use comes in the appropriate situations. As we examine their equivalents, mutual funds, in the following section, let's have this in mind. Let's now turn our attention to mutual funds. Picture a chef cooking an excellent meal. The chef masterfully chooses a range of foods that complement each other's flavors, rather than focusing on just one. Similar principles apply to mutual funds. A professional fund manager oversees a collection of funds from numerous clients to invest in a diverse portfolio of stocks, bonds, and other securities. These investments are handled actively. This indicates that in order to optimize returns for investors, the fund manager constantly assesses the market and modifies the portfolio. What are the advantages then? Professional management comes first. Investing decisions are made for you when you use a mutual fund. The expert uses their knowledge and experience to help you navigate the market's intricacies. Another significant benefit is diversification. Your investment is diversified among a variety of assets with a mutual fund, which helps reduce risk, as opposed to putting all of your eggs in one basket. Let's not overlook the possibility of increased profits. Even while it entails greater risk, actively managed mutual funds can produce larger returns, particularly in markets where a knowledgeable manager can seize opportunities and trends. Still, there are drawbacks. Increased fees are a big one. More resources are needed for active mutual fund management, and investors pay the price for these expenses. Consider it as a way to compensate for the chef's experience. Additionally, there is a chance of human error with active management. Even the most skilled fund managers are prone to making poor decisions that could result in losses. Furthermore, higher volatility may result from the frequent use of aggressive trading tactics. Comprehending mutual funds involves weighing the potential for increased returns against the associated risks and expenses. Compared to index funds, it's a more active method of investing. As we move forward, think about how this fits into your risk tolerance and investing goals. Comparative analysis. Now, let's put index funds and mutual funds side by side for a more precise comparison. How have they historically performed? It's like comparing two athletes' track records in a long-distance race. Historically, index funds have provided steady, consistent returns mirroring the market. On the other hand, mutual funds, with their active management, have had varied results. Some outperform the market, while others fall short. It's a spectrum of outcomes based on the fund manager's decisions and market conditions. When it comes to costs, index funds generally take a smoother, less costly path. Their passive nature means lower management fees and expense ratios. On the other hand, the actively managed route of mutual funds often comes with higher prices. These are the toll booths along the way, paying for expert navigation. It's crucial to consider how these fees can impact your overall returns in the long run. Even slight differences in costs can add up significantly over time. As for risk, index funds offer a journey with predictable terrain, reflecting the market's overall ups and downs. They're generally considered lower risk due to their broad diversification and passive strategy. Mutual funds, in contrast, walk a path with potential highs and lows, influenced by the fund manager's decisions. This can lead to higher rewards but also greater risks. The skill and strategy of the fund manager play a crucial role in navigating this path. So, which is right for you? That depends on your investment goals, time horizon, and risk tolerance. Are you looking for a set-it-and-forget-it approach, or are you more inclined towards a hands-on strategy with the potential for higher returns? Remember, it's not necessarily an either-or choice. Many investors find value in holding a mix of both index and mutual funds, striking a balance between stability and growth potential. Practical considerations for investors. Let's get practical now that we've covered the foundations of mutual funds and index funds. The first step in making investments is to comprehend your individual financial situation. Think about your investment objectives. Are you putting money aside for your child's education, your own retirement, or a down payment on a home? The time horizon and goal of your investments may have a significant impact on your decision between index funds and mutual funds. For long-term goals like retirement, the stability and lower fees of index funds may make them a compelling choice, allowing your investments to grow steadily over time. Your tolerance for risk comes next. Consider this your degree of comfort with changes in the market. While some investors want a stable foundation, others are more like tightrope walkers who are okay with a bit of wobbling. Index funds, with their steady market-mirroring performance, may be your best option if you're risk-averse. Conversely, the higher return potential of mutual funds better suits your risk tolerance if you can withstand more ups and downs.